Hello everyone, welcome back to the Let's Dream Civils YouTube channel. Today we are going to discuss about a very important economic situation. That is, rupee crashes to a fresh record low against the US dollars. This topic is important for UPSC GS paper 3, current affairs and exchange rate concepts. In this session, we will discuss why rupee is falling, learn important economic concepts, analyze positive and negative impact from the UPSC perspective. Let us start with the main headline, that is, Indian rupee has fallen to 94 rupees per US dollar, which is a record low level. So, this means now we need to pay more rupees to buy $1. So, the concept of comparing one currency's value to another currency is called as the exchange rate. That is, how much money you have to exchange in order to buy another currency. Now, let us understand why and how the rupee fell. The foreign investors have sold around rupees 3,254 crore rupees worth of shares. Why are they selling these shares now? Because there is an ongoing geopolitical tension in West Asia which is creating a demand for dollars. So, they are selling these Indian shares in rupees and then they are converting them into dollars. This move will decrease the demand for rupees and increase the demand for dollars. In turn, the value of Indian currency will fall. The rupee value fell for 23 pies in just one day, and in this 1 week alone, rupee value fell for about 1.4%. Now, let's look into the global macroeconomic drivers behind the weakening of rupee value. There are three major factors. First one is geopolitics. Escalating West Asia conflict and US blockade of the Strait of Hormuz is affecting our trade. This is creating a trade deficit for us. What is trade deficit? When you pay more money for your imports but earn very less money in your export. So basically, when a country's import is greater than export, that is called as trade deficit. So the second factor, energy prices hike, is the result of this first factor, geopolitics. India imports of about 85% of its crude oil. So, when the oil price increase, we have to pay more dollars, and now it is $107 per barrel. Okay, and then the third factor is dollar index. That is the strength of dollar against the other currency, and now it is increasing. The dollar strength is increasing because investors are converting their money to US dollar because it is considered as the safe haven for the assets. So the dollar is becoming strong. The domestic market contagion. So this happens when the investors sell one sector of their assets or share and invest in the another sector or share within the same country. Okay, so that is like selling the IT and banking sector shares and investing in the dollar or gold or anything they feel safe for now. So basically it will be dollar or gold whenever there is a global crisis is happening. Okay, so due to which the Sensex fall for about 982 points and the Nifty slumped to 275 points. So this risk of sentiment worsened the rupees fall. What is the RBI's intervention strategy to save INR's value? RBI have sold the US dollars from their foreign reserve in the interbank market, which will increase the dollar supply and decrease the dollar price. Okay, so when they sell the US dollar in the global market, it will increase the supply of the dollar so that the price will also decrease. And then RBI limited the net open positions for bank at $100 million. That is, the banks cannot buy and hold the dollars more than 100 million. So, why they are doing this? Because when banks accumulate the dollar while selling the local currency, it will contribute to rupees rapid decline. So, can there be positive impact from this? If so, what are all they? Export competitiveness. So, when the rupees value fall, Indian goods become cheaper in the foreign land, cheaper abroad. So, exports might increase. And the remittance gains. The NRIs will send money to India because they will receive more Indian money for every dollar sent home. That is basically they have received $8,400 for sorry, 8,400 rupees for $100. Now they will receive 9,400 rupees for the same $100. And then the import substitution. When imports become so expensive, the traders might look for the substitute of the same product in the domestic market, so which will increase the local production. And this supports our initiative Atmanirbhar Bharat. What is the negative impact? So when import becomes costly because of this widening trade deficit, it will result in the increased cost of crude and gold. And then when the fuel price increase, it will also increase the transport cost. And when the logistic cost increase for the agricultural products, it will result in the food cost increase, that is inflation. And the payment of loans in US dollars becomes more costly. For example, if you have bought loan when $1 is equals to 83 rupees, now while repaying the same alone, you have to pay 94 rupees for the same $1. And then the foreign education and the travel expenses for overseas stay will also increase and will also get, which will result in the tourism getting affected. Thank you so much for watching. If you find this video helpful, kindly share the channel for more such informative videos. Thank you. Stay tuned.